Well, let's head to business now. Of course, everything is connected. Insecurity also affects businesses, and that's why it's a problem that must be solved. Good morning. Welcome to Business Morning on Sunrise Daily. And we start off, as usual, from the global space, telling you what's going on with global oil prices. It rose on Thursday after data showed U.S. crude stockpiles fell more than expected last week, while the China economy is affecting a lot of things. The central bank is cutting its reserve ratio. Let's look at the numbers right here. Brent has gone up. Yesterday about this time, it was still in its 70s, 77 about. Now it's $80, $80.29 for a barrel at 0.3%. WTI is still far off there. I mean, the space between them is really big today. Yesterday it wasn't that much. $75.40 a barrel after it gained 0.4%. Now, what are those factors affecting it? We saw that it drew support from hopes for China's economy. China is a major consumer of global oil, so whatever happens there affects the price. And we also see that China's central bank announced a deep cut to bank reserves on Wednesday in a move that will eject about $140 billion of cash into the banking system, giving the economy hope of increased activities. Meanwhile, geopolitical tensions in the Middle East is still there, still a factor, though price gains were capped as risk premiums have already been priced. Now let's go to the global grain space. Now, Chicago corn futures edged higher on Thursday, with the market trading close to its highest level in 2 weeks, supported by concerns over lower production in Brazil. Looking at the prices now, we see wheat gained 0.9% to close at $6. Not close at this time, it's about $6.16 for a bushel. Soybeans also is up 0.4% at $12.45 for a bushel. Now we need to note that the corn market dropped to a three-year low last year, and stressful heat. Weather is a major factor when it comes to grains. Heat is a forecast for crop areas of Argentina, which has been on course for a bumper harvest. Also, commodity funds were net buyers of CBOT, one of the exchanges. CBOT wheat, CBOT corn, and soy meal features. That is what happened yesterday. And strong domestic demand is tightening India's corn supply. So the country's consumption of the animal feed ingredients is growing up to 2 million metric tons a year. Now let's come back home to Nigeria. Yesterday, the Federal Inland Revenue Service, very boastful, they collected a record 12.34 million trillion naira tax revenue for the Federation last year, 2023. And that was more than the target. The target was 10.7 trillion. Meanwhile, this might mean you are paying more taxes. Well, meanwhile, the federal government has handed the agency a target of 19.4 trillion naira for this year, 2024. And the chairman, Dr. Zaka Didiji, has said that this is achievable with the emplacement of effective collection system and ensuring a viable economic environment for businesses to prosper. According to the breakdown, it shows that oil revenue accounted for 3.17 trillion naira of the total takings, representing 25.6%, while non-oil revenue was 74.4%. That's 9.2 trillion naira. Still in Nigeria, yesterday I did say that it's a season of economic outlook. Yesterday, the NESG, that's the Nigerian Economic Group, Summit Group, had theirs, and pleasantly they had the governor of the Central Bank of Nigeria. He's been rare with the media, but he was there virtually. I'm sure you saw that on our news at 10 yesterday. We'll bring it to you on our subsequent bulletins. But they shared some observations, that's the NESG, and more importantly, the roadmap that they think would help the economy to stabilize in 2024.
Doesn't look like a large meeting since some of the participants are joining virtually, but that does not belittle the importance of the subject matter. The Nigerian Economic Summit Group is sharing observations on the performance of the economy in 2023. but it is focusing more on how best to navigate policies and implementation for a better 2024 in the stabilization phase with a projection of 3.5% GDP growth.
This phase then talks about achieving growth, not just about growth, but actualizing our natural resources to drive our collective purpose as a nation. And the first part to start with is understanding our natural capital. We are blessed tremendously with our natural capital. If we can achieve this, it will impact our GDP size, it will impact our economic structure, it will impact our employment and our poverty and inequality situations.
Brilliant ideas do not make impact, and the Chief Executive Officer is aware of that.
So the cyclic nature of NESG's activities, the Outlook report at the beginning of the year, then we jump into the reform execution and monitoring with government, then we show up in October at the summit to signal where the country is, what we won on, what we lost on. Then we jump back into, again, reform action and execution. That cyclic process, whilst it looks mundane, is part of how you build national conversations that change a country over a generation or more.
And so, for the use of the government and private sector and economists,
these and more are some of the content in the NESG 2024 macroeconomic outlook, which also has the economic justification.
That's right. Thank you, sir.
How many persons do you want? What is the limit?
We'll be getting some more details on that roadmap which NESG launched yesterday with the CEO. But let's take a commercial break. We'll be back to have that conversation. And so it's now time to delve into what the NESG has. So let's see some of their observations just before we move to 2024. Some of the observations of the NESG from what they launched yesterday, that's the real GDP growth averaged 2.5% for the year, for the first three quarters. Non-oil sector retained its role as the primary driver of the economy, while all sectors' performance had repercussion, on other sectors. We obviously have some other observation. If I could have that, Nigeria's trade balance improved. Okay, inflation remained high. Our pocket, our purchasing power showed that to us. We don't need to be told. Remain high amid stalled productivity. External trade positions strengthened, but we didn't see that reflect in our external reserve. Our external trade went up. We saw the numbers there. Then the NESG concluded by saying that policies' impact worsened economic growth in 2023. Now, let's bring in the Chief Executive Officer of NESG, Dr. Tayo Aduloju, joins us virtually from Abuja. Dr. Tayo, good morning.
Good morning. Thank you for having us.
Yeah, good to have you. I mean, you were very busy yesterday, so thank you for coming out early to talk to us. And we've seen some of those things that you outlined for 2023. The policies' impact worsened economic growth for the year. I'm sure, I mean, it's not new. The subsidy removal was a major one last year, and I don't think we've gotten over it yet.
Well, I think when we deal with these big structural reforms, the first thing is to remove the politics from the messaging. These type of changes do not have short-term positive impacts anywhere in the world. They need some time to kick in and create the adjustments before you start to see the results of this type of reforms. What needs to happen then during the short term is you need to see a combination of market reforms and social reforms that cushion the effect. It's the effectiveness of those, for example, cushioning effects in terms of pro-poor strategies, etc., that just gives the citizens a sense of managing the short term. So I think if you looked at our signaling on these reforms, we never thought in the short term we would do better. And I think when Mr. Ruwani speaks, he echoed almost the same sentiments the whole of last year. These are not reforms where in the short term, you just turn it around and it begins to perform. And I think when we listened to the central bank governor yesterday, I mean, they are still in price discovery mode at the central bank. And these are some of the things that require that you have better policy coherence and sequencing, especially on the cushioning effects of big pieces like a subsidy removal and, of course, the unification of the exchange rate. So that was something we definitely expected to see. Some of the things that became tricky then is how did the cushioning effects in terms of reforms like pro-poor policy, the government's palliatives, for example, the Declaration of Food Security and its transmission effects, how well and efficiently those programs were executed would then have an effect on the short term, how much of the direct effects of the policies citizens felt. But in the short term, there was no way we could have avoided the worsening effects on the economy by the end of 2023.
All right. So a lot of your conversations yesterday was centered around the three phases for moving forward, the outlook and all of that. And we have them right here, I believe. So we have the stabilization phase, which you spent a whole lot of time on. You have the consolidation phase and the acceleration phase. These made up a lot of your conversations with your chief economist yesterday at your event. Could you tell us, where are we now, stabilization, consolidation, and how do we know where we are? How do we move to the next phase?
I mean, I don't think anybody needs a crystal ball or a prophet to tell us that we are dealing with fantastic levels of macroeconomic stability. Our heat map showed across board all indicators signaling that this broad macroeconomic systems instability is the key issue. So the question of pursuing economic growth comes after you deal with the fundamentals of stabilizing the economy. And I think that was where our signaling comes from. Going forward, we need from the monetary and fiscal policy authorities clear forward guidance on the specific packets and bundles of reforms, their sequence, in terms of priorities that target reducing inflation, for example, and dealing specifically, for example, with former high growth sectors that have become laggards in the short term. We cannot pursue simultaneously stabilizing the economy and pushing for high growth, which in the medium term is possible. But to get to that ambition of government to get back to high growth, you must stabilize the macroeconomic fundamentals. And I think that's why where we are dealing with high macroeconomic instability across all the key indicators. Where we need to go in the next 12 months is a coherent economic policy coordination framework where the Monetary Policy Authority, we saw some better signal from the governor yesterday on where he would want to go in terms of reducing inflation and in terms of his approach to dealing with price stability. We need to see more of that signal and the effect of that signal on market regulators, especially in terms of ensuring that these sectors that have been heavily impacted in 2023 by the two flagship reforms, as you were, of the new government, begin to move out of the region of low growth to being back as drivers. One of the things we noted yesterday is that traditional drivers of growth are now lagging behind. And it's important to get those sectors back on track. So I think where we are is clear. Where we need to go in the next 12 months is this seamless coordination of fiscal, monetary, and trade policy aligned with an investment framework that deals with some of the uncertainties that the volatility we've seen in the key macroeconomic indicators has created. Now, this volatility has also created a huge speculation, lack of confidence. That confidence needs clear strategic policy communications on an ongoing basis. And so we hope that on the coordination side of the economy, we see a periodic and regular kick-in of policy communication signaling, and like I said, a strong sense of forward guidance on the key pieces of reforms to make the difference that we need to see.
All right, so we said that you also, very brilliant ones, because you did break it down on how we can actually move on from one stage to the other. You said improving productivity in agriculture sector, transformation of production sectors for job creation and global competitiveness, reinvigorating of services sector, and attracting private investment. I don't think a lot of these are new, and I know you said this even in the report that we just used. The strategy to get these bright ideas done, implemented. NESG obviously is not the executive arm of the government, they're not even in government, so you have the bright ideas, but you cannot implement it. But how do you accelerate the implementation? You have relationship with government agencies and different arms.
So the great thing about NESG's work is that, as you saw yesterday, it's not about trying to do government's work. It's about providing some economic analysis, clear advocacy on key areas. So, for example, we know that in the stabilization phase, moderate inflation rates will do us good. It will drive fiscal stability, to drive external sector stability, it drive output growth stability, for example. And that's something that we've signaled to the central bank. And we are at least encouraged by the fact that the central bank, in its unveiling of its own new strategic agenda, has identified inflation reduction with some clear pointers to how they might go about it. Of course, we will wait to see the full central bank strategic agenda document to be able to add some more value to and input into that conversation. So it's about creating a sense of clear focus areas. So and then getting the authorities to look at how we measure success and how we track that we are doing well in moving towards those areas. So, for example, on the fiscal policy side, the fact is that we are still dealing with a low liquidity vis-a-vis our needs, both on the domestic and the external side. So we need to see a combination of a clear investment stimulation plan, a clear borrowing plan, a clear spending plan. So when we do borrow money or when we do make money, where will we put it, and what's the sequence we will invest those resources in to drive significant growth? We need to see a strategy around solving risks in terms of the government whilst it's a new government, it has inherited a set of liabilities that it must manage, and that creates on the fiscal side a line of sight on liquidity for the monetary policy side. So these things have to work together, and our goal is to make sure that we nudge the authorities to create, like I said, better signal, clearer understanding of where they are.
All right, Dr. Tayo. Obviously, there's always a lot to say, but we have to thank you so much because we need to delve into another side of the conversation. The Chief Executive Officer of Nigerian Economic Summit Group. Thank you so much, and we will follow you up to ensure that we work together, coordinate, and get it all done.
That would be great.
So we have to switch over. Yeah, thank you. We have to switch over now because, well, Mr. Ruwani, Mr. Bismarck Ruwani, the Chief Executive Officer of Financial Derivatives Company, is standing by. Mr. Ruwani. We did take a little bit of your time there. We apologize, but this report. But Mr. Ruwani, the Chief Executive Officer of Financial Derivatives Company, joins us now to talk about interbank short-term rate, which has slipped. We know that Dr. Taya talked about the cost of borrowing, and of course, that affects businesses funding, the cost of funding. But Mr. Ruwani, tell us about this. Good morning, and thank you for your patience. We had to steal a bit of your time right there. So tell us about this interbank rate that has slipped and what impact it could have for businesses.
We have to look at interbank rates in the context of the market. The interbank rates hover around the short-term liquidity or long-term, short-term saturation of funds at a point in time. But also we had treasury bill rates that went increased yesterday from their low. For example, 90-day treasury bills went up from 2.5 all the way back to about 5%. And in the long end, also 365 days also increased. So while we have primary treasury bill rates increasing, we had interbank rates slipping because of some form of excess liquidity in the interbank market. But the impact of all of this volatility and liquidity saturation has been that it has brought the Naira under pressure. As you know, the Naira fell to its all-time low yesterday of 1,400 Naira to a dollar at the power market. In the official market, NAFEM market, it was 882. The gap between the two is about 600 Naira. In terms of percentage variance, it is significant. And that is the effect and the impact of policy, bad sequencing and structural defects in the market structure, in the market that we have. So we now have the Naira trading at 1,400 to the dollar and 1,780 to the pound. And why? We asked a few questions. People said, well, there are some people paying school fees, some airline remittances. In spite of the signal that came out from the central bank governor was very clear that they're clearing the backlog, and in reality, they are clearing the backlog. But the problem is that the market, there has been no system right now where we now say the Central Bank of Nigeria is going to sell the sum of 200 million Naira today in an open auction. Let us see that happen. If we don't have that, people become tentative and more speculative and afraid that the exchange rate is going to depreciate. I think that is the most important thing, the fear of exchange rate depreciation. We started at 1,100, as I got all the way to 1,400 a dollar, and it looks as if, except something different is done, it looks as if that rate continues to depreciate, even though I believe that Naira will find its way back in the near term.
Yeah, talking about Naira, the central bank governor yesterday at the NESG event did say that the Naira is undervalued. Are you in line with that?
If you compare the Naira at the parallel market, the Naira in the NAFEM market to its purchasing power parity value, you can argue, right? But those are theoretical and abstract terms. The reality is that if you go across the road to buy your dollars today, you have to buy it at 1,400. If the official rate is 885, that currency is overvalued when you compare the parallel rate to the market rate. If you compare it to the purchasing power parity, which is a theoretical rate, you could argue that the Naira is probably undervalued to about 2 or 3%. But that's not the reality. Is what money can buy. If you go out there and try to buy the dollars, you will get it at 1,400. If you go into the supermarket now, the products that you're going to buy are priced at 1,400. The airline exchange rate is today at 1,281. So it is very clear that the Naira is under pressure because of three things. One, the amount of supply of dollars in the market is not adequate. Two, there are still some restrictions and making this in what we call an illegality premium. And three, the market, the way it operates today, is still opaque. We need to have an open auction where everybody bids, including the central bank, and everybody supplies, including the central bank. That way, there will be proper price discovery. I think we are going to get there very soon.
All right. Well, we look forward to that very soon, Mr. Bismarck Ruwani. Thank you so much for your time and borrowing on some of your time for the first conversation. Chief Executive Officer of Financial Derivatives Company. All right, just before we hand over back to the Sunrise team, let's look at the market. The market made history yesterday, I have to tell you. It got to over 100,000 index points after gaining 3% and having the equities, the market cap at 55.583. We saw over 100,000. 2 digits for the first time. If we could have that yesterday, there you have it. The volume and deals were in red, but I tell you, the industrial goods sector is still the driver of the market. Yesterday, we had over 100,000 for 101,571.11 after it gained 3%. Great market at this time. Maybe not a very good time to jump in, but it's a good market for Nigeria at this time. At least it shows investor sentiment perhaps is in the right position for us. So oil and gas did not really gain much yesterday, but we can see industrial goods, of course, Dangote Cement is still there, pushing that. The top trades for yesterday, Transcorp, Universal Insurance, and Unity Bank, were those are the top trades for yesterday. The losers they were NEM, Cadre, and TIP. And of course, the top gainers, which we saw earlier, WAPIC Insurance, Bua Cement joined Dangote Cement, and Japan Gold, they're back on stream. Oil and gas, that's what they do. We know that oil and gas is getting right there. So I did promise that today we will talk about the fixed income market. Unfortunately, we are not able to do that. We promise to do that tomorrow, God's grace, because that market also has some movement. Mr. Aruwani and Dr. Tayo did talk about, the cost of borrowing and, of course, the value of the naira. And we had the calendar released by the government, the federal government. So these are some very important. So while the NGX, the equities market, is rallying, you might not be a good time to jump in there. You might want to go to safer investment. So if you invest with the government, even when the governments change, you will still have your investment secured, and then you have your percentage, which is already set. So that means that your investment is safe. It might not be might not move as fast as you do with maybe the cryptocurrency and all of that, but it's always a safe place to be. So we'll do that tomorrow, we'll dwell on it and speak to an analyst that will help us to understand some of those background stories and what's going on there, and maybe it's a good time for you to get in there. We also have the smaller OTC markets, that's the NESG OTC. Yesterday, they're also in a bullish trend, 0.80%. So we have it there for the NESG OTC, 1,027.81. The market cap has stayed on the 1 trillion, 1.39 trillion. So this is the smaller market. It's still talking about stocks, but not as big as maybe the smaller companies and all of that go right. The activity for the NESD yesterday, we saw the volume was in the green, 910.77%. The value was, however, down 41.49%. They had 25 deals, which was more than almost 200%. So quietly, the markets are gaining up. Maybe not just the NGX, not just the equities market. 9 stocks were traded. So what it tells us generally is perhaps the country is winning more the confidence of investors, and which is a good thing. But as the NESG and everyone else have said before now, it is time to consolidate on some of those reforms that have already started in 2023, and hopefully we will see the benefits, the prices that Nigerians paid last year, and we'll see the benefits now. So I'll hand over now to the Sunrise team, Chamberlain, Malpe, and Ayo, and I know they are also looking forward to the benefits of the price they paid for the reforms, the harsh economic reforms that were made last year. We want to see the benefits in 2024.